Let's turn now to an expert when it comes to the bond market. We've got Sean Egan of Egan Jones Bond Ratings. All right, Sean Egan, so how important is this? Does this really matter that they put the AAA credit rating of the United States on negative watch?
It absolutely does. You can, not the fact that S&P did it, but rather the fact that it's now widely recognized that the U.S. is not assured of a AAA rating going forward. It's really a sea change. It's a marking of an end of an era. There's never been another time that I can remember that the U.S.'s credit quality has been put on negative watch.
Well, Sean, what does this mean? Does this mean specifically that it's going to get more expensive for the U.S. government to borrow money? And isn't that exactly what the Federal Reserve wanted in a sense? They wanted people to get rid of low-risk assets and go buy stocks, go buy risk.
Rest assured, the U.S. government does not want their credit rating to go from AAA down to AA+. We put our rating on negative watch as opposed to negative outlook as of the beginning of March. And it really is a reflection of the fact that the debt as a percentage of GDP is now in excess of 100%, and the deficit to GDP is about 8%, which is far higher than at any other time, excluding post-World War II when we had completely different circumstances.
Well, Sean, what does this mean for the actual cost of borrowing? What does this mean for individuals? Is it going to get more expensive? The dollar's going to get weaker?
The likely outcome is that interest rates are going to bump up over time. The real question is whether or not how the U.S. government is going to react to that. You need to cut expenses and increase revenues. It doesn't have to be done right away. But I think that people in our shoes elsewhere want to see that the U.S. government is making progress in getting their house in order. It's obviously not limited to the U.S. It seems like every other sovereign is having difficulty, the latest being Greece having to pay over 15% for two-year paper.
Sean, S&P coming out with some news headlines now saying that they're not going to downgrade muni debt categorically, and also that the threat of deflation has receded in the United States. Do you believe in that?
Certainly, deflation has receded because one of the obvious responses is to print more currency, which, of course, would stoke the money supply and therefore stoke some inflation. I think that the markets are looking for some comfort. It's very important. The credit quality of the U.S. government is absolutely critical because pricing for many asset classes is based off of that. And if the credit quality slips, the cost of borrowing is going to increase, and the cost of funding all types of assets is going to increase, and you're seeing that fear reflected in most markets this morning. Well,
do you think that the U.S. dollar will strengthen if indeed interest rates go up? That means it'll be better to loan your money to the government. You'll get more money back.
The offset to that is that the debt is likely to increase, so I don't think it's a pure one-to-one relationship.
All right, so tell us, what do you think this means for corporate credit markets? You're an expert when it comes to corporate debt. You were taking a look at Citigroup today. Their results are out. The stock is actually up right now. So what does this mean for corporate debt?
I think in general, U.S. credit quality for most corporations has improved over the last probably eight quarters or so. The probability of rating downgrades has decreased quite a bit. So I think you have a lot of cross currents here. It's interesting the way the consumers have become stronger, corporations have become stronger, and sovereigns, for the most part, have become weaker because they've oftentimes taken on the obligations of a lot of financial institutions, including in the U.S.
Sean Egan, if you had the unenviable task of being the Secretary of the Treasury right now, what would you do today, Monday, April the 18th?
I think try to develop a long-term plan, something beyond just the current budget. I think the markets are looking for comfort of where the credit quality of the U.S. government is going to be going over the next 5+ years. So it doesn't really matter. In fact, it's probably a negative to increase taxes in the very short term. Something that gives investors comfort that the U.S. is going to maintain a sound currency, a sound budget over the next 5 years will go a long way.
All right, I want to thank you very much, Sean Egan, joining us from Egan Jones Bond Ratings.